So in this chapter, chapter 10, we'll be talking about payroll taxes, and then we'll be going through some calculations that demonstrate how to calculate both employment taxes and income taxes. So we'll start out with discussing withholding taxes, and withholding taxes really are an approximation of the proportionate or share of tax liability for the employee. And we make adjustments to the amount withheld based on the number of withholding allowances that we claim on Form W-4. So, for example, if we have children that are under 17 and a spouse, for example, we may want to claim more withholding allowances, and that means we have less taxes that would be withheld from our checks. Two general methods then of federal tax calculations. One is the percentage method. It's really a two-step process where we have to determine, we use a range of percentages to calculate the taxes, but we have to then determine the number of withholdings, and then we will make some calculations that I'll demonstrate later. Another method is the wage bracket method. Here we can just use a table to look up the income, and then based on the number of allowances and the tax filing status of the taxpayer, we can determine how much is to be withheld. And in this case, we don't need to first calculate the number or amount of withholdings because that is built into the table. Various types of employee and employer taxes. One is, which are part of the FICA, Federal Insurance Contributions Act, is old age survivors disability. We often think of it as Social Security, OASDI, and the rate is 6.2% for the employee, and the employer would match that. And the maximum amount that is subject to this Social Security tax is $128,400 for 2018, and this is indexed to inflation. Another type of common withholding that relates to employment taxes is hospital insurance or Medicare, which is 1.45% for both the employee and the employer, and there is no maximum, there is no upper threshold on this. So all the gross income is taxed. I mentioned there was a match, of course, by the employer for these two types of taxes, and then an additional 0.9% for the Medicare is withheld if the employee has excess or wages in excess of $200,000. There is no employer match on this additional tax, however. This is only imposed on the employee. Another type of reporting of income is for cash tips. And so if a tipped employee works and earns more than $20, they're required to report their tips to the employer by the month following or the next month. And employees would receive and use Form 4070 to report the tips. Now, even though they have this $20 threshold in which you don't need to report to your employer, it's still income and should be reported on Form 1040. And like any income, employers must withhold income tax and FICA taxes on the employee tips. Large food and beverage establishments of 10 employees or more, or I should say more than 10 employees to be more precise, are considered the large establishments which would have to allocate the tips to the employees if they don't report their tipped income. And at least 8% of the gross receipts would be a portion to or allocated to the employees. Now, the employer would allocate these tips and then report them on Form 8027, which would demonstrate how the apportionment was made to the employees. It is interesting, I think, that the employers are not required to withhold federal taxes on allocated tips. But they would be reported on W-2, which means that the employee would have to pay income tax on them. So if the employer is collecting these taxes every time checks are issued, for example, and they have to match as well, then how often must the employer make payroll tax deposits to the government? And we determine this based on what we'll call a look-back period. And the look-back period for 2018 is from July 1st, 2016 to June 30th, 2017. So those are 4 quarters between July 1, 2016 and June 30th, 2017. And if in the look-back period the amount is $50,000 or less, then deposits only have to be made monthly. If, however, throughout the look-back period, the amount of wages is greater than $50,000, then the deposits would have to be made by the employer every other week or semi-weekly. And so for semi-weekly deposit schedules, taxes associated with any payroll that are paid on Wednesday, Thursday, or Friday would be due the following Wednesday. And taxes with payrolls that are paid on Saturday, Sunday, or Monday, or Tuesday would be due the following Friday. And these deposit schedules have to be kept by the employer. They have to be paid on time, and they have to be paid using the electronic funds transfer payment system. So if an employer ever accumulates $100,000 or more in taxes on any day during the deposit period, they must make those deposits the next banking day, regardless of whether they're a monthly depositor or a semi-weekly depositor. Indeed, if they do accumulate this much in deposits, this amount of money in deposits, then that employer would automatically become a semi-weekly scheduler for the remainder of the calendar year and the following year. We use Form 941, which essentially is a reconciliation between the payroll tax liability and the payments made, and we report this on this form. And it is due by the end of the month following the close of the quarter. So this is just a reconciliation or a reporting schedule. And we would do this at the end of every quarter. If there's, however, a tax liability of less than $2,500 at the end of the quarter, then this amount can be paid when the Form 941 is filed. Otherwise, we wouldn't make a payment. We would keep to the regular deposit schedule using the electronic funds payment system. Self-employment taxes are based on net earnings in excess of $400 generated by a sole proprietor taxpayer, and it's something we covered in Chapter 6. So if you operate a small business, you generate more than $400, then you would need to report or collect on yourself. Essentially, you have to report and collect self-employment taxes. And as a self-employed individual, you would have to pay both ends. You have to pay both the employer's portion and the employee's portion, which you pay 15.3% of FICA, which includes both the employee and employer portion of Social Security and the employee and employer portion of Medicare. By the way, I'll go back a minute and just kind of discuss one more thing regarding the self-employed. You use Schedule SE to report the any deductions for adjusted gross income. One thing that we need to remember with a self-employed individual is that yes, they can deduct as a business expense their portion, the employer portion of any Social Security they pay on behalf of their employees, but their salary or earnings that they from their own business cannot be deducted. Another kind of tax we pay is federal unemployment tax, or FUTA. It is 6% in total of the first $7,000 of wages. So states have maintain and operate and administer the unemployment funds system, and so the maximum credit that would that a federal government would accord to companies that pay into a state unemployment tax fund would be 5.4%, and then the rest, the 0.6%, would be paid to the IRS. And we use Form 940, which is filed annually by the employer to report and to reconcile the FUTA or federal unemployment tax liabilities and payments. And I'll demonstrate these calculations in an Excel spreadsheet later. Household workers are considered Schedule H workers, and these workers are considered employees and are therefore subject to federal FICA and federal unemployment taxes. If, for example, you pay wages of $2,100 or more in 2018, then federal withholding taxes are withheld from these workers. If wages of at least $1,000 were paid to all household workers combined in any calendar quarter in 2017 or 2018, then we must withhold and we must pay federal income, FICA, and FUTA taxes on those household earnings. And we report this on Schedule H, as I said. And this would be completed by the employer and taxpayer and submitted with the Form 1040. And the taxes due for all household employees paid are due when they file the Form 1040 at the end of the year, at the tax year, for example. Employers, many of us have gotten W-2s in the past, and we know that this is really a reporting of our wages and the taxes that were withheld. And then the employer would send copy A to the Social Security Administration by January 31st of the year following, or the next year after the close of the calendar year. And then Form W-3 is a transmittal form that summarizes all W-2s prepared by the entire company, and that is sent with copy A of all the W-2s. I'll demonstrate this calculation later relating to supplemental wage payments. If, for example, an employer received a bonus, then there are a couple of ways of calculating the tax on that bonus. One is just a flat tax of 22%. Another is to combine the supplemental payment, like the bonus, with the regular wages, and then calculate the withholding tax. The backup withholding, an employer or vendor must withhold 24% of things like interest, dividends, rents, royalties, commissions. If the payee fails to provide or furnish a correct taxpayer ID number, could be one, the employer number, federal employer number, or it could be a Social Security number, this tax identification number. Employees are required to complete a W-9. If the employee, for example, fails to furnish a correct tax identification number, such as Social Security number, this can result in a $50 penalty for each request. If there's a willful neglect in completing Form W-9, then they could be subject to a $500 penalty. So in the next video, then I'll go through some calculations that discuss and round out how these various taxes are calculated, the different methods of calculating them, and we'll run through some examples that will demonstrate how to apply some of these concepts in situations that are presented at the end of the chapter.